3 years ago, we released a video titled 5 Taxable Account Rules to Follow for Tax-Efficient Investing. Now, since posting this initial video, many of you have written in explaining how helpful these rules have been in helping you get more from this very common but often problematic account. In today's video, I want to revisit these 5 rules, add some additional context, and talk about if these rules still hold strong today. The first thing you need to understand is that your taxable account is quite different from your other retirement account options. In the case of a traditional IRA or Roth IRA, you are taxed only once when you contribute or withdraw from that given account. Any income generated during growth is not taxed in that given year. You could buy and sell investments at will and not have any negative tax consequences. A taxable account is a completely different beast on this front. Yes, this is a valuable account in retirement, but it's also an account that can be taxed much more frequently. Dividends and interest are taxed each and every year. Selling an investment creates a taxable event, so you can't make changes willy-nilly without considering tax consequences first. Because of this, we label a taxable account as a leaky bucket. Keep in mind that anytime you have a taxable event during growth, this is generally a negative thing. Owing taxes means less will be invested on your behalf going forward in the future. And so all 5 of these rules are ultimately around patching up as many holes as possible in this leaky bucket. Rule number 1, I'd recommend you avoid owning mutual funds in a taxable account. Now, with any of these rules, if you're currently breaking one of them and it's an easy fix, great, obviously fix it. However, if you are breaking a rule but it will cost you greatly in taxes to try to remedy this mistake, it may not make sense to fix it immediately. Run the numbers or work with someone who can run the numbers on your behalf. That being said, why shouldn't you own mutual funds and what should you own instead? Well, mutual funds are considered a pass-through entity. Anytime a fund makes a change, like selling out of one stock to buying to another stock, this creates a taxable event internally into the mutual fund that ultimately flows through to you, the fund investor. Now, that mutual fund manager isn't directly thinking about your specific situation, which means you are likely to have taxable events when you don't want to or when they're not optimal for you. Instead, I recommend using ETFs rather than mutual funds. ETFs have a mechanism that allows them to swap shares without the same pass-through mechanism. On the screen, I have 3 funds in the large cap growth space. All of these invest in the same sub-asset class, and therefore you can see from the chart have high correlation in the ups and downs of performance. 2 are very popular mutual funds, while the third is a popular ETF. Now, obviously, you can see from the graph, there is a raw performance difference, but let's just imagine all of these funds had the exact same gross performance. The after-tax performance in the mutual funds would be worse because of something called forced capital gain distributions. Let me explain. Here's the distribution history for the Vanguard Growth ETF. In 2023, this ETF released $1.80 in distributions for each share you had in this fund. These distributions are effectively just dividends from the underlying companies this fund invests in. And that's really all. And dividends are something that's effectively unavoidable. Now, I used a rough estimate for share price throughout the year, but basically we are looking at a very small forced income percentage. To give you a more accurate number as we sit today, dividend yields in VUG are around 0.45% right now. Compare this to Fidelity's Contra Fund, and we see a completely different story. In 2023, total distributions per share were 69 cents, but this is off a much smaller share price. If you look at the table breakdown, the majority of these distributions were capital gains due to that pass-through mechanism, meaning this fund had forced income of around 4.5%. So every $100,000 invested meant you had another $4,500 of income on your tax return. American Growth Fund of America was even worse with 7.5% forced income. Now, this is a very big deal. I used to say this would be somewhat similar to you turning over 7.5% of your position each and every year and basically just resetting the cost basis. It's actually worse than this because really if you were turning over 7.5% of your account in a given year and you only had, let's say, 50% unrealized gains, then you're really only having capital gain distributions of something like 3.75%. This is a 7.5% capital gain distribution. So it's almost like you're turning over much more of your account. As an investor, you would never do that because it would create a tax drag for no specific reason. Now, when we talked about this rule 3 years ago, I had a couple of commenters point out that not all mutual funds are created equally. Active mutual funds will have this problem, but index funds won't because index mutual funds aren't doing the same buying and selling activity leading to all of those taxable events. And although it is correct that this problem will be minimized with index mutual funds, it's not completely eliminated. Here's a snapshot from Vanguard looking at year-end capital gain estimates of some of their mutual funds. In red, I highlighted 4 mutual funds that are definitionally index funds, yet still have estimated capital gain distributions here in 2024. And so although this is less common with index funds, there are still forced distributions that happen. Here's another interesting data point to chew on. We find so many investors are so attuned these days to the fees that they're paying to funds and for advice. And this is overall a great trend. However, according to American Century Investments, tax costs are an expense that dwarf fees for a taxable account investor. As you can see from the graph, the average mutual fund stock investor sees an almost 1% lower return after taxes than the average ETF investor. You should focus on this expense as much, if not more than expense ratios. Rule number 2, don't invest in high income funds in your taxable account. Many investors believe their investment strategy needs to shift completely when they retire. They go from wanting growth in the accumulation phase to now feeling like they need to generate income in order to live on in retirement. When income becomes the focus, too many people fall into a trap of investing primarily based on income yield. Funds with high dividend yields are preferred. Bonds that generate higher interest become more attractive, and so on. Here at Safeguard, we believe this is extremely problematic and leads to worse overall investment decisions. But getting too far down this rabbit hole is a little bit beyond the scope of this particular video. So click the text in the upper right-hand corner to watch a video specifically on this point. For those that watch that video and still think it's best to be an income investor in retirement, avoid holding the highest income investments, specifically in your taxable account. Income is bad in the context of your taxable account because each year it creates a taxable event which causes you to withdraw from that account to pay taxes. Thus, you have less compounding in the future. Let's use an example of a high yield bond invested in your taxable account versus a traditional IRA. We're going to start with $250,000 in each account, and we're going to invest in a high yield bond earning 6.5% on a consistent basis each year. An investor will pay ordinary income taxes on interest. So we're going to tax that interest at 22% per year. Interest will have no effect in the traditional IRA because you are only taxed when you withdraw funds. As you can see from the table, the longer that we run this comparison, the worse the results between the taxable account and IRA become because of the taxes on interest drag down performance. In year 1, both accounts generated the same amount of interest. But in the taxable account, $3,500 of that interest has to go to taxes. So in year 2, the interest is going to be higher in the traditional IRA because of that tax deferral. Run this out 20 years, and we see the total growth in the IRA is nearly 50% higher than the taxable account. That being said, we're going to owe taxes on that growth in the IRA. However, because of the power of deferral and compounding, you could pay a 32% tax rate on withdrawal from that IRA and still come out ahead compared to the taxable account. Again, when we're just looking at growth. This is precisely what we mean when we talk about the term tax drag. A similar analysis can be done when looking at dividend yields. You want to hold a high dividend fund. Okay, great. I recommend doing it in tax-protected accounts. The same thing that happened with interest happens with dividends, albeit on a smaller basis because dividends are generally taxed at lower rates and often offer lower yields than fixed income. Any way you slice it, however, larger dividends lead to lower after-tax returns if we equalize out general performance. To be clear, some level of dividends from stock investing is inevitable. All things being equal, if you own a growth stock fund paying a 0.5% dividend yield and a value fund paying a 3% dividend yield, it's generally best to hold the value fund in a more tax-protected account and then hold that growth fund in a taxable account. Yes, you will still have some dividends, but you're minimizing dividends. More on this later, however. Rule number 3, when you do receive dividends in a taxable account, don't just automatically reinvest them, at least when you're in retirement. In the accumulation phase, when you are only adding to your taxable account and never really withdrawing, reinvesting dividends is fine. But in retirement, take those dividends and determine the best use of that capital. You've already been forced to take a taxable event. See if you can use that taxable event now to your advantage. For a lot of retirees, it might be easiest to just take the dividends as part of your retirement income for the year. Well, then blanket reinvestment obviously doesn't make sense here. The other thing you may want to do with dividends is use them to rebalance your account. With a taxable account, you shouldn't just rebalance on an annual basis like you might do with your other accounts, because remember, buying and selling investments creates a taxable event. So instead of naive rebalancing, you can use dividends to rebalance back to your target allocation. Or you can use dividends to buy into a more tax-efficient alternative investment. If you're taking dividends and distributions from your mutual fund and just reinvesting those back in, you are essentially perpetuating the tax drag problem further. Take those distributions and dividends and invest in a more tax-efficient ETF alternative. Rule number 4, don't invest in target date or blended funds in a taxable account. Target date or blended funds are funds that hold multiple assets all inside one fund. It makes it a lot simpler for investors. So you might hold bonds, stocks, and cash and more all in one fund. These are problematic for a few reasons. First, in the case of target date funds, as you age, the fund will invest more in bonds, which generates more forced income in the way of interest, which drags down your performance as previously shown. But this isn't the only issue. First, I don't like blended funds in general, whether in a taxable account or retirement account, because you are forced to withdraw pro rata. Say you own a 60-40 fund with this asset mix. Let's say stocks are up massively. You might want to take all of your income from stocks, but that's not possible. If you need $100,000 of retirement income, you are taking $10,000 from cash, $30,000 from bonds, and so on. Say the stock market is cratered and it's down 30%. Let's say bonds and cash are up in comparison. You might want to take all of your income from safe assets, but unfortunately, that's not possible. You have to take $10,000 from cash, $30,000 from bonds, and so on. So you have no control over the withdrawal process. You can only control how much money you take out of the overall fund. But here's a trickier problem that compounds over time. As anyone holding a portfolio of multiple assets knows, allocations will drift over time. Say bonds earn 4% in a year and stocks earn 24%. Well, stocks are a much larger share of the fund now until the manager rebalances. And guess what? The manager is going to rebalance at least annually, which means that rebalancing is going to create a taxable event and probably mean you have forced capital gain distributions. On top of that, however, the bigger the position grows, the more you are going to have invested in bonds, which generates interest. So right now that interest might not be a big deal or pain in the butt. Wait 10 years until that position has doubled. On top of this, because the stock position in the fund will likely grow faster than fixed income, the overall fund is going to have unrealized gains, which makes it more difficult to exit later. So you have a fund that is generating a lot of interest, but also generating gains. So exiting this fund over time or adjusting its position sizing is incredibly difficult. Instead, I'd recommend breaking up a multi-asset fund into specific pieces. You want to hold a 60-40, invest 60% in a stock-specific fund, and then 40% in a bond-specific fund. This way you have much more control over the account and allocations as a whole. Rule number 5, avoid active management in a taxable account. When I talk about active management, I'm speaking to the idea of buying and selling investments on a regular basis in order to beat an index either on an absolute or risk-adjusted return basis. As I'll show in a second, active management has a really tough track record in proving that it even works on a reliable basis. That being said, if you are going to have some active management, don't do it in a taxable account. A taxable account is best managed when you are a long-term investor. This is because the government will tax you at lower, more preferred rates for investments you hold longer than a year. Investments held less than a year will be taxed at some of the highest rates you will see because they are subject to ordinary income tax plus an added net investment income tax at higher income levels. This means that active manager is going to need to outperform by that much higher of a rate to make up for just the tax difference. Now, an active manager still can hold investments for longer than a year and still use those more preferred rates. But in general, you're going to see a lot more short-term gains with active investing than you would with long-term buy and hold investing. Now, if active investing has a strong record of outperformance, maybe the extra taxes are worth paying. But data certainly isn't favorable to that case. Here's data from my semi-annual report published by S&P Dow Jones Indices called the SPIVA report. It compares actively managed funds to their index counterpart on an absolute and risk-adjusted return basis. What we see over a long period of time, greater than 10 years, is the vast majority of actively managed funds underperform the benchmark. The data is just heavily against there being reliable outperformance here, and keep in mind this is all before taxes. Now, taxes might be the biggest expense in this equation, specifically for a taxable account investor, but there are additional costs to keep in mind. If you're looking at an actively managed fund or advisor, can they still reliably outperform after you're likely paying them a higher fee? After accounting for likely higher taxes? What about accounting for the behavioral gap? What do I mean by this behavior gap? Well, by definition, active management only works by drifting away from index returns. When active works, you're drifting and earning higher returns. But inevitably, every active fund underperforms and potentially for long stretches without clear reasons why. It's easy to stick with it during outperformance. But what about multi-year underperformance? You exiting the fund at poor times will ultimately drag down the performance that you experience. And just to provide you with a bit more data on this front, on the right-hand side of the screen, I have a table showing after-tax returns of a stock index investor versus the median active fund. And as you can see, the tax costs are significant. Now, these are the 5 big rules for investing in a taxable account. And these have mostly stayed the same over the past 3 years and are still true today. But I do think it's worth mentioning a few guidelines that maybe aren't as robust enough to become a rule. Many investors that hold bonds in a taxable account will automatically think it's best to hold muni bonds versus taxable bonds because muni bonds aren't taxed federally. However, just because something isn't taxed doesn't automatically make it better. On the screen, I have a comparison of treasury yields to muni bond yields based on Bloomberg benchmarks. Notice the muni bond returns are quite a bit lower. It's also true that muni bonds are a bit riskier than treasury bonds. But leaving all of that out, what tax rate would you need to see for a 1-year muni to make more sense than a 1-year treasury? Well, about a 35% tax rate or greater. If your tax rate is lower than this, it doesn't matter that the muni bond is quote unquote tax-free. The taxable bond is a better return after taxes. Another thing I see quite popular is individual stock investing in a taxable account. In fact, I noticed this seems to be a new marketing trend in the financial industry with marketing around direct indexing. I've also noticed quite a few financial advisors try to sell higher net worth investors on individual stock investing because of all of its benefits in a taxable account. Now, if you're someone with $1 million in a taxable account, I don't care if you do a little stock picking, investing here and there with a small portion of your portfolio, but beyond that, I don't see the benefits to individual stock investing. Remember, the data shows it's incredibly difficult to outperform the market. Any investment methodology you have, like wanting to invest in cutting edge technology, can be better done through an ETF with that overall directive. But beyond that, there are a lot of quote unquote benefits to individual stock investing that I don't see as beneficial at all. One of those is tax loss harvesting. Well, let's say that you own Microsoft stock and it's down $20,000 because of poor market performance. This could be a great tax loss harvesting opportunity. We can lock in that loss and take it against our tax return, but ideally we want to reinvest back into something that will recover that loss and be a similar investment to Microsoft. Due to wash sale rules, we can't directly buy back into Microsoft. So instead, we might buy Apple, a company that's in a similar industry and has somewhat correlated performance historically. The problem this could create is maybe Microsoft recovers after tax loss harvesting, but Apple stock mostly remains unchanged. Well, now tax loss harvesting just costs you greatly on an overall performance basis. Change this up to an ETF example and you could sell, let's say, a large cap growth ETF at a loss, and if you're careful, buy back into another large cap growth fund that has 99% performance correlation. Now, you almost guarantee a benefit coming from that tax loss harvesting. Another benefit sold to investors is the ability to strategically withdraw. You can sell a bad company and keep your money invested in all the good companies. Well, hey, that's great. Can someone send me a list or a link to all of the good companies so I can only invest in those? If it were that easy to identify good and bad companies, then everyone would be an ace investor. Active management would outperform more consistently, and the whole case around strategic withdrawals would be moot in the first place, because why the heck would we own anything but good companies? The thing is, it's not that easy. So you need $10,000 from your portfolio. Where are you pulling from? If you own 100 stocks, you just created a whole lot of complexity, because which of these 100 stocks do you pull from? In my opinion, this is at best just needless complexity. Then the final guideline, as you are investing across all of your retirement accounts, don't view each of these accounts so separately where you need to have the same allocation in each account. View your entire situation as a whole. This opens the door to be able to allocate the right funds to the best accounts based on taxability. For instance, when we break up stocks as a general asset class, we can break it up into smaller components like value stocks versus growth stocks, small cap, mid, and large cap stocks, or even US versus international. If we just compare based on dividend yields and remember what we learned earlier, it will be better to locate lower yielding stocks to your taxable account and higher yielding stocks to your tax protected accounts. The same is true and can be done when looking at bonds. Now, every situation is different in terms of what is the best asset location strategy for that situation, which is why this is a guideline and not a rule. But data from both Vanguard and Morningstar show that asset locating properly can lift after-tax returns by as much as 0.5% per year. If you're someone wanting to learn a little bit more about asset location and how to manage it best for your situation, click on these 2 videos right here. Thanks so much for watching this video today. I hope it helped in making you a better, more tax-efficient investor. Always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.